The U.S. jobs report just sent silver down hard, and the timing of it matters more than the number itself. On Friday, non-farm payrolls came in stronger than expected, 256,000 jobs added versus the forecast of minutes. Silver dropped below $30 per ounce. That wasn't a coincidence. It was a coordinated response to a narrative shift, and understanding why that shift happened tells you more about what's coming than the price move alone. The jobs report wasn't just strong, it was structurally inconsistent with what the Federal Reserve has been signaling for months. Powell spent the last quarter preparing markets for rate cuts, framing inflation as contained and labor markets as cooling. This report contradicted that entire setup. Strong employment means the economy isn't slowing the way the Fed claimed it would, and that forces a decision. Either the Fed was wrong about the slowdown, or they're about to ignore their own data to cut rates anyway. Either way, credibility fractures. Silver reacted because it lives in the space between what central banks say and what they do. When jobs data suggests the economy doesn't need stimulus, markets reprice expectations for rate cuts. Higher rates for longer strengthen the dollar, and a stronger dollar mechanically pressures silver. But that's the surface story. The deeper move is about positioning. Institutional players who were betting on dovish Fed policy into 2025 just got caught leaning the wrong way, and silver was the easiest exit. Look at the structure of the drop. It wasn't a gradual decline, it was a liquidation event. That's not retail investors changing their minds about inflation. That's leverage positions being unwound because the narrative they were built on. No. Longer holds, the jobs number, didn't change the fundamentals of silver supply, industrial demand, or long-term monetary instability. It changed the short-term trade thesis. And in a market dominated by derivatives, that's enough to trigger a cascade. But here's what the sell-off doesn't tell you. Silver's decline happened in a vacuum, where paper contracts, not physical demand, set the price. The same week silver dropped, premiums on physical bars and coins stayed elevated. Mints didn't see a flood of sellers. Dealers didn't see inventory pile up. The disconnect between paper price and physical reality widened, which means the move was financial, not fundamental. That distinction matters because financial moves reverse when positioning resets. Fundamental moves don't. The short-term question now is whether the Fed acknowledges the strength in this report or dismisses it as noise. So if they hold rates higher through the first quarter, silver could test support levels it hasn't seen since late 2023. If they cut anyway, citing global slowdown, European weakness, or any other justification, they'll confirm what this audience already knows. Policy is driven by control, not data, and that confirmation is a long-term buy signal, not a sell. What traders need to watch in the next 2 weeks isn't just price, it's the language around the February FOMC meeting. If Powell downplays the jobs report, if he emphasizes underlying softness or lagging indicators, that's a signal that rate cuts are still on the table despite the evidence. That would mean the dollar's strength is temporary and silver's drop is a technical reset. Not a reversal, but if the Fed pivots to a data-dependent stance that actually follows the data, expect continued pressure on metals and a repricing of inflation expectations across the board. Long-term, this changes nothing about the macro case for silver. Central banks are still expanding balance sheets, governments are still running deficits that require monetary accommodation, the debt-to-GDP spiral hasn't reversed. What this jobs report did was expose the fragility of the narrative that was holding short-term positioning together. And it reminded the market that central banks are not in full control of the variables they claim to manage. And when control is questioned, volatility increases. Silver's role in that environment isn't as a trade, it's as a hedge against the gap between what institutions say and what the system can sustain. The price dropping on a single data point doesn't invalidate that, it reinforces it. Because if one jobs report can shake confidence in the entire rate cut cycle, then the cycle itself was built on assumption, not structure, and assumptions break under pressure. So the question isn't whether silver is a buy or a sell after this move. The question is whether you're positioning for the narrative or the reality. The narrative just shifted. The reality hasn't. Silver dropped hard the moment U.S. jobs data hit the wire. Not a gradual slide, not a technical pullback, a sudden, coordinated move that caught late position traders off guard and reminded everyone else that this market doesn't move on fundamentals alone. The number itself wasn't extraordinary, but the reaction was. And that tells you everything about who was positioned, who was waiting, and who used that exact moment to execute. The official story is simple. Stronger jobs data means the Federal Reserve has room to keep rates elevated. which pressures non-yielding assets like silver. That logic holds on paper, but it doesn't explain the speed, the volume, or the timing of the sell-off. Markets don't collapse in unison unless there's coordination, and coordination at this scale doesn't happen by accident. It happens when large players, banks, funds, or entities with access to leverage and derivatives decide the moment has come. To flush out weak hands and reset positioning before the next leg, this wasn't retail panic. Retail doesn't move fast enough to create that kind of pressure. This was institutional futures. Contracts were dumped in size, stop losses were triggered in waves, and while the headlines focused on jobs, the real story was playing out in the derivatives market, where paper silver dominates price discovery and physical supply is irrelevant. The paper market can absorb selling pressure that would never exist in the physical world, and that's the point. When you control the mechanism that sets the price, you control the narrative. But here's where it fractures. Physical silver didn't follow the same trajectory. Premiums stayed elevated. Dealers didn't flood the market with discounted inventory. Buyers didn't vanish. In fact, demand for coins, bars, and allocated metal remained steady, which means the people who own real silver didn't interpret the drop the same way the futures market did. They saw a discount, they saw manipulation, and they held that divergence matters because it signals that the paper market is increasingly detached from the physical reality of supply, demand, and actual scarcity. The question isn't whether this was coordinated. The question is, why now? Jobs data is released every month. Silver has been rising steadily for weeks. So why this number, this reaction, this exact moment? Because someone needed to break momentum before it turned into conviction. When price starts attracting new capital, when retail begins to pile in, when sentiment shifts from skepticism to belief, that's when the reset happens. Not to destroy the asset, to control the entry point, to make sure the next wave of buyers comes in on their terms, not yours. This is standard operating procedure in manipulated markets. The price rise enough to create interest, let momentum build enough to draw in speculative capital, and then pull the rug at a moment that can be justified by a headline. Blame the data, blame the Fed, blame anything except the structure. And while everyone argues about whether the move was justified, the players who triggered it are repositioning for the next phase. If you're holding physical silver, this doesn't change your thesis, it confirms it. The fact that paper can be dumped without affecting physical availability proves the disconnect is real. The fact that premiums didn't collapse proves demand is structural, not speculative. And the fact that this happened now, after weeks of upward pressure, proves someone felt threatened by where price was. Heading, they don't manipulate markets they don't care about. They manipulate markets they need to control. Going forward, expect more of this. Expect volatility around data releases. Expect sudden drops that don't align with fundamentals. Expect the gap between paper and physical to widen, because the end game isn't about price. It's about who controls supply when the system needs it most. And if you're paying attention, you'll notice that while price was getting hammered, central banks kept buying quietly, consistently, without fanfare. That's the move that matters, not the noise, not the headlines, the accumulation happening behind the structure. So don't chase the drop, don't panic, and don't assume the market just corrected itself. Understand what happened, why it happened, and who benefits. Then position accordingly, because the next shock won't announce itself with a press release. It'll show up the same way this one did. Fast, coordinated, and designed to separate those who understand the game from those who are still playing by the rules. Silver dropped hard the moment the jobs report hit the wire. Not gradually, not over the course of the day, immediately. And that kind of reaction doesn't happen by accident. It happens when positions were already lined up, when algos were primed, when the move was structural, not spontaneous. The non-farm payroll numbers came in stronger than expected, and within minutes, precious metals were sold off in coordinated fashion across futures desks, ETFs, and leveraged accounts. This wasn't retail panic. This was institutional repositioning executed with precision. The mechanics are straightforward but deliberately obscured in most commentary. Strong employment data signals the Federal Reserve has room to maintain restrictive policy without triggering recession optics. That keeps real rates elevated, which pressures non-yielding assets like silver and gold. But more importantly, it gives cover for continued dollar strength in forex markets, which makes commodities priced in dollars more expensive for foreign buyers and less attractive for speculative longs. Positions: the silver market, already thin and prone to violent swings, became the release valve. When leverage unwinds in a low liquidity environment, price doesn't drift, it collapses. What most analysis ignores is the timing. This jobs report arrived during a period of heightened geopolitical tension. ongoing central bank gold accumulation by BRICS nations, and persistent supply concerns in industrial silver. None of those fundamentals changed, yet price moved as if they didn't exist. That disconnect reveals something critical. Short-term price is not about value. It's about positioning, margin calls, and narrative control. The sell-off wasn't a rejection of silver's role in the system. It was a function of how silver is traded within the system, a system designed to suppress volatility in favor of managed perception. The ripple effect extends beyond the metals themselves. Mining equities sold off harder than spot prices, amplifying losses for those holding shares instead of physical. Retail investors who entered positions based on momentum or influencer hype found themselves underwater within hours. Meanwhile, sovereign buyers and long-term accumulators likely viewed the drop as opportunity, not crisis. This is the division that matters: those who react to price and those who respond to structure. And the former are always at the mercy of the latter. Here's what the job data actually tells you about silver. Employment strength is interpreted as economic resilience, but it also reflects an economy still dependent on credit, expansion, government spending, and asset inflation to maintain the illusion of stability. That environment doesn't eliminate the need for hard assets. It delays the recognition of that need. Silver's industrial demand, solar, electronics, defense systems, remains intact regardless of payroll statistics. The disconnect between paper price and physical fundamentals doesn't resolve itself through headlines. It resolves through supply shocks, currency crises, or the eventual breakdown of confidence in fiat-based settlement systems. Analysts will frame this as a technical correction or profit-taking. But corrections don't happen in isolation. They happen when someone wants them to happen, when clearinghouses need liquidity, when derivative exposure needs to be reset. The silver market is one of the most manipulated in existence, not because of conspiracy, but because of structure. A small number of banks hold outsized short positions. A small number of exchanges dictate margin requirements. A small number of narratives dominate retail perception. When all three align, price does what it's told. What comes next isn't predictable, but it's not random either. If the Fed pivots toward easing in response to economic slowdown or financial instability, metals will reverse violently. If geopolitical fractures deepen and trust in Western financial architecture erodes further, physical demand will overwhelm paper suppression. If industrial users begin securing long-term supply contracts outside exchange mechanisms, the float available for price discovery shrinks. All three scenarios are in motion simultaneously. The question isn't whether silver rallies. The question is, which force breaks the current equilibrium first? For those watching closely, this is not the moment to react emotionally. It's the moment to recognize what's being revealed. Volatility is information. Sudden moves expose leverage, positioning, and control mechanisms that remain hidden during calm periods. And the overnight drop after the jobs report wasn't a market speaking. It was a system acting, and systems act to preserve themselves, not to reflect reality. Silver's role in the transition away from dollar dominance, in the reindustrialization of supply chains, in the physical settlement of trade outside SWIFT, none of that changed because of one employment print. Watch how central banks respond in the coming weeks. Watch whether physical premiums decouple further from spot. Watch whether mining output continues to decline while industrial demand holds firm. These are the variables that matter. The rest is theater designed to shake out weak hands and reinforce the illusion that markets move on data, not design. They move on interest. And right now, the interest is in keeping metals contained until they can't be